absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations, investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really, really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It doesn't feel like we've had a weekend for about a month, but let's attempt to anyway. Let's get you to the weekend. From New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, heading towards another week of losses on the S&P 500, a third week of losses. On the Russell, we're looking at a third week of gains. Check out the future right now. The futures board on the S&P 500. We're up by 0.75% on the S&P. On the Nasdaq 100, we're positive by 1%. The outperformance once again on the Russell 2000, the small caps up by 1.5%. The stat of the month comes from Jim Reed at Deutsche Bank. The Max 7 down nearly 13% since the record high back on July 10th, with the Russell and the small caps outperforming, Lisa, by a remarkable 24 percentage points over the period.
That statistic highlights the ultimate question underpinning what we've seen over the past 3 weeks, which is this a gloomy sell-off on the heels of some sort of growth scare, or is this a really healthy kind of growing pains related to a sort of positive transition to some of the more leveraged stocks to the economy? That ultimately is the angst underpinning what we've seen.
Yesterday was a super messy session, and we'll be talking about that mess throughout this morning. We need to talk about the economic data. PCE a little bit later on this morning. Yesterday, jobless claims. You just got the sense from a lot of people that claims were the difference between having time and running out of time. And there was a belief based on claims coming in a little bit better, GDP coming in firmer than expected, that we have just a little bit more time. Companies are saying something very different though, Lisa. Big airlines are warning about airfares. Automakers like Stellantis are struggling with sales. You go through the top and bottom end of the consumer. The world's largest food company, Nestle, cutting its outlook. Even the luxury players like LVMH and Kering are coming out and saying, you know what, I think we've got a bit of a problem.
The problem for market participants is understanding if this is a problem with margins, if this is a problem with consumers that still have money but are being more discretionary with where they spend it, and actually just an incapacity to spend. It's two different things, because you also had Hermes, evidently Birkin bags are just fine. So on the flip side, it's sort of selective spots that are doing just fine while everything else kind of struggles. You look at going forward, and it seems like we're moving to a point where September is a lock-in. July is out of the picture. Next week is out of the picture. But ultimately, there is a distinction between preventative rate cuts and reactive cuts. And the market is coalescing around the idea of preventative rate cuts in September, which could be less of a negative than reactive cuts to true deep weakness.
Don't you think the Birkin bags are like their own universe?
Yeah.
Low end, high end, and then you've got Birkin bags.
Maybe it's the people who buy them are in their own universe. Maybe that's part of the distinction.
50 people on an expensive island somewhere who can afford them. Equity futures on the S&P look a little something like this. We're firmer by 0.75% on the S&P 500. This is your bounce back from a really volatile session yesterday. In the bond market, the 10-year 4.2328, and in foreign exchange, the euro at just about 108.50 and positive by almost a tenth of 1%. Coming up on this program this hour, we'll catch up with Ben Laidler of Bradesco on the Great Rotation, Tobin Marcus of Wolf Research as Trump and Harris debate the next debate, and former World Bank President David Malpass ahead of Treasury refunding next week. We begin with our top story, the Great Rotation gathering some momentum. The Nasdaq starting down a third week of losses, with the Russell looking to make it 3 weeks of gains. Ben Laidler of Bradesco writing this. This is the longer-awaited bullish rotation in markets, not the start of a broad correction. This broadening is key to the sustainability of the bull market. Ben joins us now for more. Ben, let's get there. First of all, as we stare down, a third week of losses on the Nasdaq. Ben, tell me what you look at to distinguish between something bad and something good when you see price action like this.
So the tectonic plates of this bull market are absolutely shifting. That's unleashing some tremors, but this is a rotation, not a sell-off. The equal weight S&P is up over the last few weeks, even when, as you mentioned, big tech is in this fairly significant correction. And I think this is emblematic of what's coming. Markets are looking at the assets which are most sensitive to the economic soft landing and interest rate cuts. And small caps is just the canary in the coal mine here. That's why it's reacting the most violently. But it's also, I think, a reminder of how a little bit of money can go a very long way in all these assets, whether in the rest of the world or all these other sectors, which we basically forgot about over the last few years as this sort of one-legged big tech bull market sucked up all the attention.
Ben, let's dissect it. Let's dissect this mess over the last couple of days. You identify three different things. What's driving it? What's amplifying it? What's globalizing it? Can you just go through that point by point?
So, big tech's had this massive rally, valuations, obviously high. Everybody's built up on AI, et cetera, et cetera. Any sort of disappointment, and maybe we got that from Google, just amplifies the angst which is already out there, and people that were looking to pull those triggers, pulled those triggers. I don't think that means that tech's a bad story though. Tech was doing very well before AI. Tech doesn't need AI. It's just maybe things got a little bit frothy. But this is 30% of the S&P 500. Concentration is very big, and that unleashes some sort of volatility. But at the same time, we have data which we saw yesterday, which I think validates the soft landing. We have a Fed which is getting ready to cut in September. This is pouring gasoline, I think, on looking at those assets which are most sensitive to that scenario. And that's not big tech, that's everybody else. And then thirdly, the US has just got so sort of supersized that any stumble, I think, reverberates around all assets. And that's the cost, I think, that we've taken in many parts of the world. I'm sitting here in the UK over the last couple of weeks. But I think that will fade. And I think actually many of these assets, whether they're emerging markets or Europe, are in this sort of same bucket as sort of small caps, which will do very well in this new environment, and where a little bit of money will go a very long way.
I love that a lot of people come on the show and they have vastly different appearances in terms of their outlooks, and then you start talking about their time frames, and it turns out that they all have the same view. It's just sort of depending on where your time frame is. What is your time frame for this great rotation and this sort of wonderful outcome, given the fact that over the short term there are a whole host of different analysts, including Julian and Emmanuel, who see this continuing on a technical basis, who see this continuing potentially if we don't get massive beats from big tech next week?
So ultimately, I think, the fundamentals matter, and I think the fundamentals sort of support this rotation. Tech is not growing earnings, or big tech, 70% anymore. It's still great. It's going to be 40 to 50, but absolutely it's consecutive slowdown. And at the same time, everybody else is no longer in an earnings recession. Those earnings are consecutively recovering, and I think we have visibility on getting back to double digit by the end of the year. So I think this rotation is very fundamental. I think it will happen reasonably slowly, or at least I hope it happens reasonably slowly, because what we're seeing right now, I think, is just the big tech has got so supersized that when it stumbles, it spews volatility everywhere. We have the VIX now, back at long-term average levels. So, I'm a little bit scared of the very short term, but I think this rebalancing of the economy and of the stock market will hopefully be a moderate that plays out over time. And remember, we've been waiting for this for a very long time.
You said fundamentals matter, and you're talking about how smaller companies should really benefit in this kind of environment and have been sort of thrown out with the bathwater. How do you understand Ford? How do you understand Stellantis? How do you understand American Airlines and Southwest and all of these different companies, consumer-facing companies that are coming out and saying, actually, things are getting worse than we thought that they'd be, and we cannot pass on our price increases?
Absolutely. And this is why I think, there are going to be plenty of idiosyncrasies out there, right? There are 500 stocks, the S&P 500, but I think overall, as we saw yesterday, the consumer continues to be in pretty good shape, incrementally slowing. Demand, this is not a demand story. This is a story where demand is okay, where profit margins are getting a little bit of relief because inflation's come down. We're seeing overall profit margins in the S&P 500, rising. And I would argue that outside of the Mag 7, earnings expectations are quite low. And I think this is why, and we're going to find out next week, 40% of the S&P 500 reports, 4 of the Mag 7 report. But I think this is going to be the best earnings season in 2.5 years. Let's not lose sight of that. Earnings are going to be healthily double digit, I think.
So Ben, let's take out tech and let's just look at the consumer names, particularly the story that Lisa just mentioned. Demand's okay at the right price. And I think that's what we hear from all of the airlines. I think that's what we see from the automakers as well. They don't have the pricing power anymore. And when that starts to happen, we know what starts to happen with margins and what happens elsewhere. So Ben, where do you get that confidence around that consumption story when what we're hearing from the companies is that they don't have pricing power anymore?
Yeah, I think this is going to gradually play out. Am I a little bit concerned of the sort of face-ripping rally we've had in small cap and how much we've priced in the last 2 weeks? Yeah, I am a bit, because I do think, this will take a little bit of time, right? The economy will probably keep incrementally slowing, but we need the interest rate cuts to sort of come through. The consumer, the economy will gradually sort of firm up. I think in the US, but what I would also say is there's a big international component to this. The global cycle, I think, is quite different from the US cycle. Europe, EM, has either bottomed or started to recover, and I think that earnings cycle is A, maybe a little bit further ahead, and B, it's a lot more cyclical. So in Europe, for example, this is going to be this quarter will be the end of the earnings recession in Europe. And I think by the end of the year, we could be seeing 20 or 30% earnings growth in Europe, just given the cyclicality of earnings. And I think the same goes for parts of EM and potentially parts of small cap.
When we're talking about timeframes, it's actually quite important because a lot of people have come on the show and said, for the remainder of this year, there is some visibility. There's a sense of what different economic policies could be. There's a sense of some of the dynamics heading into November. After that, it gets a lot harder. What gives you conviction that regardless of who wins the U.S. election and some of the policies that result from that, you still could have the environment that you're seeing that could be supportive of smaller companies, even though there's some pretty differing kinds of policy proposals out there?
To be clear, I'm not sure small cap would be the first place I would go. As I say, that is the canary in the coal mine. That's giving us a very clear signal of what people are looking at. But, I'm not that bullish to think that, the US economy is just going to turn on a dime here and that's going to take small cap with it. So, I would be looking at financials, I'd be looking at industrials, I'd be looking at Europe, I'd be looking at EM, maybe before I go to small cap. But again, I think, the US economy is in a good place. We are about to get interest rate cuts, from the Fed, which I think will go a long way to giving us maybe incremental visibility on that. And maybe controversially, I think the election is maybe a volatility event and maybe less of a fundamental event. In fiscal policy, for example, I don't see huge differences between the candidates. I think the base case is we end up with a gridlock Congress. I think the risk is we overdo the politics a little bit.
Ben Laidler of Bradesco, offensively bullish. It's good to catch up, sir. Ben, thank you. Appreciate it. Look, one person's rotation is another person's growth scare. That's the last week or so. Bank of America, Michael Hartnett putting it like this. Credit spreads signal the correction's healthy. Then you look at the yield curve of commodities, and they say it's sinister. Got to pick one.
It's very difficult, and the different economies have been moving in different kind of pacing, and that's part of the problem. I like how language matters. For bears, it's profit margins are getting squeezed. For bulls, it's profit margins are getting some relief. It just sort of highlights, how you look at things.
It's a very different way of framing things. Some people enjoying their weekends, other people not so much. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It capped a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. Uber, Lyft, and DoorDash have won a California lawsuit. The state's top court unanimously ruled that the companies can continue to classify California drivers as independent contractors. The ruling clears what investors had regarded as a major regulatory hurdle. It's also expected to save companies millions of dollars that they otherwise would have had to pay drivers. App-based gig companies have long argued that their drivers aren't considered employees, entitled to minimum wage and overtime protections. Despite the unanimous ruling, further legal and legislative fights are expected ahead. And as the Olympics kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say that people were seen fleeing the sites in vans. Eurostar, for its part, says that its services to London and Brussels have been impacted, with several trains delayed or canceled. The national rail company says it will have to repair its network cable by cable. And that's your Bloomberg Brief. John.
Not a great start. That is super sad. Danny, thank you. Danny will be back with us in about 30 minutes' time. Up next on the program, debating the next debate.
I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. I think the voters deserve to see the split screen that exists in this race on a debate stage.
We'll discuss that split screen up next, live from New York City this morning. Good morning.
Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
Already, the elusive endorsement gets delivered by the Obamas to Kamala Harris. There's a bit of a honeymoon period over the last couple of days, Tobin. I'm just wondering from your perspective how much longer that honeymoon period lasts.
Well, I think that depends in large part on how Vice President Harris continues to perform on the campaign trail. Part of the reason why Democrats have been so energized and unified is just the relief at being out from under this Biden catastrophe that they've been living through for the course of the past month. But another part of it is that she's looked pretty good on the trail. You know, the early paid media's look good, a couple good ad stuff so far, and a string of solid performances from her. So she keeps delivering good performances. I think Democrats are very ready to remain enthusiastic. I think there's a sort of palpable eagerness to have something to root for. But obviously her 2020 campaign did not go flawlessly, to say the least. It's totally possible that we see things start to go a little bit less uniformly positively. And if so, then I think we'll start to see cracks on the Democratic side.
Tobin, I thought the New York Times Siena poll that just came out yesterday was fascinating, not because it showed that there was more of a tie between Kamala Harris and Donald Trump than we've seen for months with with President Biden. But this part, it said that nearly 90% of voters said they approved of Mr. Biden's decision to exit the race. When have you ever, Tobin, seen 90% of voters agree on something so pivotal as the sitting president stepping down from a race?
Yeah, that's about as high a number as you could get in polls. As someone who has run a lot of polls in my life, you can. It's really hard to come up with something that gets a higher number than 90. So look, I think it just goes to show again how much palpable relief there is at being out from under this. There were differences of opinion, obviously, on the Democratic side about how to handle this, how much pressure to put on Biden. There were certainly some people, including for example, the Congressional Black Caucus, who were standing with Biden through much of that pressure campaign to try and get him out. But now that he has left, I think there's very, very little second guessing of that. And again, there are some people who were hoping to have another candidate come out somehow, find some way to run a mini primary, figure out if you can get one of these promising Democratic governors at the top of the ticket instead of in the runner-up slot where they're being considered right now. But that was never really an option. And with all those people immediately bowing out, I think people are now backing the horse that is available to cheer for.
Tobin, there were a lot of people who were scratching their heads at the J.D. Vance pick by former President Trump as the vice presidential pick, given the fact that he was very closely to Trump when it comes to some of his policies. Within the Democratic Party, how much momentum is there for picking a vice presidential candidate that really is more centrist, even than perhaps Kamala Harris?
Yeah, I think that's what's going to happen. There's questions about which one of the various different vice presidential hopefuls she will end up going with. But, I think common sense and the reporting about who is being vetted all point in the same direction, which is that she's looking for somebody who has some, moderate record and some outside the beltway sort of vibes to them in terms of people to round out the ticket. Again, could be governors, could be Senator Kelly in Arizona, who, I think reads a little bit less Washington-y than a senator usually would by virtue of his experience as an astronaut rather than a career politician. But one way or another, I think she is looking in the obvious place for the kind of person she'd want to fill out the ticket.
Tobin, it's been interesting to see the media and Democrats in the last couple of days or so almost trying to remodel perceptions of Kamala Harris's role in this administration, to separate her from the border by pointing out repeatedly, we might have called her the border czar, but she was never the border czar. This was about root causes. Tobin, I just wonder whether you can pick and choose, whether as the vice president you can say, I was involved in this, I had nothing to do with that. Can you really do that? How much distance will there be between her and the Biden legacy?
So, obviously she's going to face attacks for everything that happened under the Biden administration. Both things in which she had some level of direct role, like again, the sort of disputed portfolio about what exactly was her responsibility in terms of addressing the root causes of immigration. But even more broadly, things that happened that she had nothing to do with, she will continue to face criticism for. I have no reason to think that the Trump administration, for example, is going to stop criticizing the withdrawal from Afghanistan and kind of pin that on her as a member of the Biden-Harris administration, even though nobody believes that she was the decision maker on that. That being said, it does seem to be the case in some of the early polling from Democratic pollsters that there is less baggage with her than there was with Biden. On inflation, for example, which obviously had been one of the persistent vulnerabilities for President Biden, in addition to his age, it looks to be the case that there's like a little bit less association of the retrospective bitterness in the run-up in price levels, distinct from the current run rate of immigration for Harris rather than Biden. You know, and again, a lot of it comes down to her. Like, how effectively can she pivot away from some of these attacks, both on the Biden record and on her past positions, where obviously Republicans are already, you know, kind of criticizing her for all the position taking that she did in 2019 and 2020 around banning fracking, around decriminalizing border crossings. These various different things that she kind of signed on to during that primary when a lot of Democrats were racing to see who could get farthest left. You know, but again, flip-flopping is a thing that happens in politics. If she can give a compelling account of where she stands now and what she wants to do going forward, I think it does, you know, mitigate some of the vulnerability from things she said in the past.
They are the ultimate shapeshifters. I expect no different from either side. Tobin, thank you, sir. Tobin Marcus there of Wolf Research. I keep going back to what Libby Cantrell said just yesterday. Ignore the polls. Wait until September. Got to wait for the DNC, see who the VP pick is. Let all this bed in. Just wait a while, and then we'll get a better gauge of where things stand in this country.
That's the reason why I thought that just the approval of where we are right now was sort of shocking. The polls maybe not so much, because those are going to change quite a bit.
Yeah, going into quite a big week also for the Japanese next week.
Yeah, for the Bank of Japan to come out and decide whether or not they're going to hike rates. In a lot of the research notes that I've been reading over the past couple of days, the ultimate question is, how vulnerable is this market to an inactive Bank of Japan meeting? If they do not raise rates next week, how much does this yen weaken right back to where it was before this rally began? It feels technical in nature, unclear what's driving it. The Bank of Japan could quash that if they want to by simply doing nothing.
Dollar yen 154.30. Under surveillance this morning, our top stories. Let's start with this one. Vice President Kamala Harris pushing Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire deal with Hamas, highlighting concerns over the civilian death toll in Gaza. Netanyahu also met with President Biden and will be visiting Donald Trump at Mar-a-Lago later on today. So picture this, you're a foreign leader and you've now got to meet with three. Got to meet with the sitting president, separately from the vice president, and also you've got to meet with the former president who might be the next president as well. What on earth does policy look like after January?
Well, this is part of the reason why Peter Scheer is very concerned about some sort of geopolitical issue springing up now, because it feels a little bit, not that there's a vacuum of leadership, but that it's unclear who has the strongest grip over policy going forward. And I'm talking about beyond January of next year. It's interesting to see how Kamala Harris was trying to create daylight between her policy and Biden's policy, coming out with some harsher words for Netanyahu. And then, of course, you have Donald Trump, who is a huge supporter of Bibi Netanyahu. And this sort of acceleration of the divergence in U.S. politics by Netanyahu is something potentially some people have speculated he could exploit.
He's in a hot war. You've got Ukraine in a hot war, and they could have a very different relationship with the United States of America come January, depending on who wins in November. That's quite a turn of events. The lack of continuity in foreign policy in America, I think, is what Peter Scheer is getting at over at Academy.
And it starts to sort of raise a question of what could happen. You start talking about Ukraine, and Volodymyr Zelensky really said, look, I know you don't want to talk about things publicly, but just let us know. If you're going to be playing with our future, I just want to know what the policies are from the prospective nominees, because a lot could change, and we want to be prepared.
That's the latest in Washington. Let's get to the latest in China. Apple losing ground. How many times have we seen reports like this? Market tracker IDC saying iPhone shipments dropped around 3% in the last quarter, pushing Apple out of the top 5, as local rivals such as Huawei have been surging ahead, even deep discounts. And I think this is the important point here, failing to help boost sales of Apple at a time when the sell side leaks are getting built up on this idea that when the new iPhone drops in September, you're going to get this massive upgrade cycle off the back of it.
So here's what I'm looking for. How many international companies are going to start to X out China and propose growth models that have nothing to do with that nation? Because essentially there have been a number of reports that a number of the executives who went to China from the United States, big heads of multinational companies, don't know how welcome they are. And the rhetoric is not convincing because policy has not been. With Apple, sure, you could say that the price is probably part of the issue. You could say also that, hey, the phones have been banned by a lot of governmental agencies. There's a big push into national companies, which have exceeded, all of them have exceeded Apple for the first time. It just creates a very difficult environment to really have any predictability. We're talking about U.S. policy uncertainty. Sure. How about China policy uncertainty for some of these companies?
Look, that environment is always going to be cultivated by the central government, by the Chinese Communist Party, but also this turn of consumption, how consumers have gravitated towards national players. You mentioned Peter Scheer. That's also something Peter Scheer's been on top of. How welcome are they? Not just by the government, but also by the consumers on the mainland.
Which, again, goes to this point of how much are companies still expanding in China. You know, whenever we ask people about China, executives of companies, they always really hedge, almost invariably. Qualcomm CEO is a little bit different. He said, we like China. It's important for our business. But most executives say, you know, we're cognizant of some of the risks. It's an important market. We are aware. We want to make sure that we're, you know, being within everybody's guidelines. What they're doing is totally different. They're moving production to India. They're moving away. They're diversifying their supply chains. They're very aware of the potential risks.
It's not what they say. It's the physical reaction that gets me. You know, the jacket will be done up and then they'll undo the button because it's getting a bit hot. Yeah. And then they don't know what to do with their hands anymore. So they're sort of like this, trying to, yeah, no. It's the physical reaction. You just saw them, they react physically to it. They know it's a topic. They've been briefed on by public relations just not to touch. Don't go there. Don't go there.
Nothing good can come of it on either side of the equation.
We keep asking. Apple's positive in the pre-market, up by about 0.9%. It's a difficult one for them, I know. I want to turn to foreign exchange. Investors looking ahead to a double dose of central bank rate decisions in the next week. The Fed and BOJ both drop on Wednesday. The yen rally facing a moment of truth as the currency holds onto an advance of about 5% against the dollar since just before it began surging on July 11th. Jeremy Stretch of CIBC writing this. Should the bank desist from tightening next week, as we assume, we would be mindful of dollar yen retracing half of the recent correction. Hence, we are mindful of a correction back towards 156.90. Jeremy joins us now for more. Jeremy, we've seen massive swings in dollar yen over the last couple of days. What do you think has been going on? Is this all just about fundamentals and looking ahead to the prospect of a rate hike next week, or is it something more than that?
Well, I think there are a couple of things definitely in play in the context of this move. Clearly, we've seen excess yen short positions. Some of those have now been partly compromised. But I think also at the same time, we've seen increasing speculation of late regarding the prospects of a BOJ hike coming at next week's meeting. So in the context of yesterday's move, when we did the trade briefly below 152, we were trading in the region of 9 basis or so higher, or around that sort of threshold in terms of pricing for next week. So amplification in terms of BOJ assumptions, allied to paring back in yen short positions, have really amplified this sort of uncertainty and volatility, which of course comes as we've seen risks very much under threat in recent sessions. So I think there's certainly a couple of factors in play, but I think in terms of the BOJ, we would expect once again the bank to overpromise and underdeliver or maintain a dovish tone, and that is why we would probably prefer to anticipate that dollar yen does risk moving back higher.
Jeremy, you said there were a couple of factors at play. How much is a sort of fundamental question about the Bank of Japan, and how much is this just a couple of hedge funds that blew up?
Well, I think, as I say, we have seen significant repricing, or at least attempts to reprice the BOJ view for next week. So I think that's one of the factors. But clearly, I think there is a case to be made that when we do see episodes of market uncertainty, then it is often the case that some of those positions which are proven to be profitable are also unwound as a consequence of any uncertainties elsewhere in the market. So I think there are a combination. I wouldn't necessarily ascribe a particular sort of proportional or dynamic influence on either of those factors, but I think the combination have certainly proved to be a fairly powerful cocktail in the context of what are, of course, relatively liquid in summer markets. And that does amplify that intraday volatility.
Jeremy, how much is this a yen story, and how much ultimately is this a dollar story? Is this a question about people getting more confident that the Fed's going to hike cut rates at least in September in the face of data that's definitely cooling?
Well, undoubtedly, in our view, we have been anticipating a September Fed rate cut for some time, and we would and had been expecting the data to validate that. And I think that generally is broadly proven to be the case. Now, obviously, that GDP print yesterday was somewhat hotter than expected, but I think the underlying trend is of a slower pace of growth, certainly in the first half of the year relative to last. And I think the inflationary dynamics, as well as the labour market, are also signalling that there is a need or a necessity for the Fed to start policy easing come the September meeting. So I think there is increasing confidence in that regard. And I think it may be the case that whilst we continue to see US economic exceptionalism relative to the rest of the world in the first half of the year, I think that exceptionalism and the argument around that will start to dissipate as we move forward. And I think that does validate the presumption that the impetus of the dollar, I think, will gradually reduce, albeit, of course, there are still cross currents, not least of which in relation to US political dynamics.
Jeremy Stretcher, CIBC, looking for a swing in the other direction. Jeremy, appreciate it. Looking ahead to the BOJ and the Federal Reserve next week. I think Lisa took this conversation in the right direction. When you have a big consensus trade like this one, short Japanese yen, for this long, other things are kind of built on top of it. So when you snap back the other way with speed, and it's a speed that matters from, say, 160 down to 150, things start to crack elsewhere. Identifying where those cracks are and where they're coming from is important.
Yeah, and I don't want to spread rumors saying that someone blew up, because there's no evidence to suggest that. It just simply, there seems like perhaps there were a few, trades that sounded and rhymed very similar that were leveraged that got blown out at the same time. And we saw the unwind of that. And that's what a lot of people have been talking about. Very hard to attribute some sort of fundamental reason behind that.
Dollar yen has had a 157 handle this week and a 151 handle this week as well. That's quite a range. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mercedes is the latest automaker reporting a decline in its second quarter profit. It trimmed the upper range of its forecast. It now expects returns on sales between 10 and 11%. It previously said the high end could be 12%. Automakers are under pressure from weaker demand in China and a drop in purchases of battery-powered cars in Europe, with governments cutting back on financial incentives. Mercedes shares fell as much as 3% in the early trade before paring some of those losses, given weak earnings were somewhat expected. Shares are flat over the past year. And JP Morgan has launched a new internal AI chatbot in one of Wall Street's largest use cases for the technology. In a memo viewed by Bloomberg, JP Morgan told its employees to use its own version of ChatGPT as a writer, idea generator, and problem solver. The FT earlier reporting that the chatbot could do the work of a research analyst. Many of the big banks have been experimenting with AI over the last year, with hopes it lives up to its productivity and cost-cutting potential. Citigroup has estimated that the technology could displace more jobs in banking than any other industry. And former First Lady Melania Trump is publishing a memoir this fall. The self-titled book is described by her office as a, quote, powerful and inspiring story of a woman who has carved her own path, overcome adversity, and defined personal excellence. The book will sell for $40. A signed copy will be available for $75, and the collector's edition will go for $150. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that's something that the next administration is going to have to address.
Up next on the program, the former World Bank president, David Malpass from New York. This is Bloomberg. The former World Bank president, David Malpass. David, good morning to you, sir.
Good morning, John.
I want to start with this quote, and I think it's a timely conversation for us. It comes from Hudson Bay Capital, Stephen Mirren, Nouri Arabini, two people I'm sure you know well. Here's the quote. By adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them, the economy, essentially taking over the core functions of the Federal Reserve. And they dubbed this novel tool Activist Treasury Issuance, or ATI. Can we just reflect on all of this? What did you make of this piece? What are they telling us?
I love new acronyms, ATI. So activism. So Treasury has to decide every quarter whether to issue T-bills or bonds and which bonds to issue. And they do that in conjunction with Wall Street. And the problem, and I've written a lot about this in the Wall Street Journal, is that puts an overlap between them and the Federal Reserve. So that's a challenge right there. As you decide where the issuance is going, it affects the shape of the yield curve. And when you do that, you're affecting stock prices. So you've got this giant direction for capital based on whether Treasury is borrowing short short or long. Right now, for years now, they've been borrowing too much at the short end and not enough in the 10-year kind of window, the 30-year window.
And why does that deliver meaningful consequences? Can we explore that a little bit more? If you think about the shape of the yield curve, it's the same amount of debt. It's just being issued at the front end of the yield curve and less at the long end. Why are there meaningful consequences when you increase or decrease the level of debt at the longer end of the curve?
When QE started, that was the Federal Reserve buying a lot of bonds in, say, 2010, 11, 12, 13. That flattened the yield curve. So you had the Fed buying longer maturities, basically the Fed buying duration. So when the market hears that, that's positive for equities, but it's not positive for small businesses around the country. They borrow at the short end. So basically, Treasury is the Bigfoot coming in and borrowing right at the spot where your small businesses want to borrow for inventory, for construction loans. So if you could change the shape of the yield curve to be more upsloped or upsloped at all right now, you would liberate a lot of floating rate loans for people that really need them day by day in order to get their businesses growing.
Some people could say that this is actually just smart policy because ultimately the Treasury Department didn't want to lock in borrowing costs at 5% for the next 10 years. And they wanted to have a short-term kind of lease on rates that were at the highest levels in decades. Why don't you see it that way?
Hi, Lisa. I think that's a bet made by the Treasury. So we already saw a giant bet made by the Fed on duration, and they've lost, billions and billions. And I think it will end up being $1 trillion from that mistake when they were buying long bonds with short-term interest rates. Think Silicon Valley Bank, or think a hedge fund that made a bad bet. So as Treasury does that, they should be more neutral about the economy. Here we are coming into an election cycle, and they have they're holding down the long end of the curve, which props up the equity market. It fuels, think of where the capital is going right now. Treasury is borrowing short, so it means a lot of long duration capital can go into equities or can go into long-term bonds. So you have this phenomenon for years now of corporations issuing bonds and buying back their stocks. You've got dividend recapitalizations going on now. This is all a phenomenon of the shape of the yield curve, which is being controlled, I think, in an anti-growth way by Treasury and the Fed.
This may sound like an esoteric conversation. It's pretty much anything but. It's talking ahead of 8:30 a.m. on Wednesday, when we're going to get the Treasury refunding agreement, where they announce what kind of maturities and the amounts that they're going to be selling of government debt. It comes at a time where Fitch said in a recent report that heavy Treasury supply is a key risk to our lower yields call across the curve. And it comes at a time when you potentially are rumored to have an ear toward another administration of Donald Trump. What would you, if you were in a situation to dictate maturities, do in order to, say, increase maturities of U.S. government debt, while not sort of causing this massive sell-off at the long end that could be hugely disruptive?
Yeah, and I think you have to be neutral from Treasury and from Fed, that you're not trying to manipulate the yield curve. Historically, there was remember the Operation Twist, which was a big failure in a previous decade, a previous century. And so the government has tried to do this, and it ends up hurting people within the country. So all you have to do, I don't think it's that hard, is say what your goals are, that you're trying to not have the short-term funding be the most efficient. The Treasury is making a bet right now that they'll be able to refund at a lower yield later on. How do they know that? And wouldn't it be more confidence inspiring if they allowed the market to help them do that? They're asking the world to keep giving, the U.S. borrowed, the Treasury borrowed in 2023, $23 trillion in its coincidence in 2023. And so that's a giant amount of debt for the market to digest. So say to the market, we are working toward a lower yield curve that's upsloped, that's going to maximize business confidence and be very positive for growth. They're not doing that. They're saying instead, we're going to keep borrowing short term because, as Lisa's pointing out, it might be cheaper if yields fall. It might cost them a lot. Right now, it hasn't been a good bet. If you look back
the core
over the
principle,
last
as you know,
2 years,
David, just to jump in, is meant to be regular and predictable debt issuance out of the Treasury. That's meant to be the core principle. Do you think we've moved away from that? Do you think this is a permanent fixture of policy now, this tool?
Clearly, it depends on the political cycle where you're going to borrow on the yield curve, and if you're trying to prop up markets in the short term or the long term. And that also affects, and it's very important, the actual capital flows going on in the economy. So there's been this heavy bias toward big companies and toward the government. So that same point that you're making about where the Treasury is issuing means that the government, it feels comfortable with this giant fiscal debt because you're not borrowing at the long end of the curve. I think we need to go to a more neutral, balanced environment with a more independent Fed that's not really facilitating this process through its own. Is it coincidence that the Fed moved to QT to phasing out QT right now in this part of the curve? They should be allowing that long bond portfolio to run off. That would be confidence inspiring for markets.
David, it's good to catch up with you, sir. I feel like we've only scratched the surface. We need to go a lot deeper on this topic. Thanks for giving us your insight. David Malpass, the former World Bank president, on a key issue. That note and that research from Nouriel and Stephen, it has had so much attention over the last week or so. If you extrapolate it out, there's a real question: what is the consequence of higher long-term yields if you do allow them to be determined by market prices? And there was sort of this implication, maybe U.S. government officials would take the deficit more seriously if the market were determining levels. Maybe it would be more of a gut check that would actually push people to a bit more action on the policy side. Well said. Thanks. Well said. Coming up next, got David sort of nodding his head as Lisa's talking as well. Well said. Well said. Coming up next, Victoria Fernandez of Crossmark, Sucharita Kadali of Forrester Research. We'll catch up with Giorgio Falani, the AC Milan CEO, and Sheila Kahyaoglu of Jefferies. All of that and more in the second hour of Bloomberg Surveillance. The consumer. Lisa and I spent some time talking about that. There's a few companies out there saying things are weakening. Others say things are okay. What are you focused on?
Yeah, well, Jonathan, I think this is the problem that we're seeing. We don't have a consistent message coming from the earnings season telling us one way or the other so that the market can make a definitive decision on where it wants to go forward. That's what's causing some of this volatility that we're seeing in the market, especially like yesterday, up all day and then down at the end. So in our eyes, it all comes down to the labor market. You and Lisa were talking about this earlier. The labor market is key for us, and not necessarily the payrolls number. I'm looking more at the JOLTS number. I want to see those job openings. I want to see how long it's taking someone to find a job once they leave somewhere. Temporary work, we know that is a precursor to what we're going to see in the labor market as a whole. I think that U3, U6 number has kind of muddied the waters a little bit with the immigration issue. So I think focus on JOLTS, get an idea of that labor market because it flows through to everything else we're seeing. It flows through to wages. Then you have the consumer pull back, and we know the consumer is driving this economy. You get consumers pulling back, revenues pull back, margin compression, layoffs go up. It is a cycle. I talked about this with clients in Kansas City yesterday. Follow that cycle, and it tells us things are going to slow down in the second half, and we need to be ready for that.
So, Victoria, here's the question I would have for someone like you who likes financials. Why on earth would I want to own the banks going into what you've just described?
Yeah, I think we have to look at it from a technical side as well as a fundamental side. I know, Jonathan, you asked me a couple months ago, why are we sticking with financials? And look at the run-up that we have seen. It comes down to the fact that when you're going to have volatility in a market, we have the VIX up to 18, up 20% this week. You need to have companies that have strong balance sheets, good cash flows. They can handle this storm. If we're getting a re-steepening of the yield curve, which we typically get before we go into a recession or a pullback, I hate to use the word recession anymore, but as we go into a pullback, that actually will be beneficial for some of these financial companies. But we're talking the larger banks. We know Russell 2000 has done better because of some of the regional banks, but we would say stick with these larger banks with the good balance sheets. They still have people using their credit cards and paying those off. Even though delinquencies have risen, consumers are going to rely on those credit cards as well. So I think you have a couple reasons as to why in a market where a lot of elements are going down, financials still have over half of their securities in that sector over their 50-day moving average.
Victoria, you talk about diversification across sectors and across asset classes and how important that is. What does it mean to be diversified right now at a time when we've seen sort of odd correlations and a lot of the traditional sort of 60-40 aspects of portfolios haven't been reliable?
No, you're right, Lisa. And we were actually just looking at correlations in consumer discretionary this past week and how that has really fallen out of bed. You really have to be specific when you're going in and looking at names, really doing that homework, looking under the hood on the fundamentals. But for us, diversification doesn't just mean within the equity sector. You know, we've been talking about financials. We've been talking about healthcare. We've been talking about some of the staple names that have pulled back in the first part of the year as areas to go into. But we also think you need to put some money to work in that fixed income world, lock in some of those higher rates, at least for the next 18 months to 2 years to help buffer some of the volatility in the equity market. But look, there's other elements. Generate some income in your portfolio with call options. That's one of the most liked strategies that we have at Crossmark, where we're seeing a lot of flows come in. But you can also have allocations to things like absolute return strategies. So there's a lot of elements where you can go in, build your portfolio out to really kind of buffer some of this volatility. It's not just within the equity sector.
Next week's massive. I know you know this. We've got the big tech earnings from Microsoft, Apple, Amazon, and Meta. We have, of course, the payrolls report on Friday. And then on Wednesday, the Fed meeting, as well as the Treasury financing or funding agreement, which actually could be important for duration.
Absolutely.
What do you think is going to be the biggest market moving event among those?
Yeah, I think it's really hard to pick from those. But I will tell you, I'm actually going to be watching the quarterly refunding announcement. When we look earlier this year, some of the biggest spikes that we've seen in yields have come on the quarterly refunding. Obviously, the deficit is a huge issue, and people are very concerned about what's happening there. And that gives us a clue into what our interest expense is going to look like, and issuance going forward could lead to downgrades for us from some of the rating agencies. So to me, that is extremely important. We know that some of these tech names, valuations are coming down a little bit. So I don't think we'd be completely surprised if we see earnings just hit expectations, maybe not go further and guidance come down. I think we know the Fed is using this meeting as a setup for September. So to me, actually, that quarterly refunding, I think, could be key.
Victoria, do you share this view that the Treasury is deliberately manipulating the shape of the yield curve by issuing more at the front end of the curve?
Yeah, I was listening to your conversation with David Malpass, and I'm not sure if they're trying to deliberately change the shape of the yield curve, but I do think they're trying to go in and figure out a way to reduce interest expense going forward. If they can issue more T-bills in doing that, which we've seen in previous refunding announcements, then I think that benefits them. So I'm not sure if it's an intentional yield curve movement. I do think it's intentional to try to reduce interest expense, again, leading to the idea that we could get downgraded if that continues to go higher.
Victoria, appreciate your view going into next week. Victoria Fernandez across Crossmark. Lisa went through a range of stories to look ahead to next week, including payrolls. Payrolls, the estimate in our survey. Sneak peek for you, Lisa. 175 is the median estimate in our survey so far.
How low is the bar for the market to change its narrative, or how high? I mean, this is sort of going to be the key question. It's not just the actual number. I still think that the revisions are becoming increasingly important as they pretty consistently downgrade the view from the month before.
Household versus establishment, still playing that game. Unemployment, by the way, the estimate in our survey, we're looking for that to stay at 4.1%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. We can cross over to Danny Berger. Hey, Danny.
Hey, John. The world's biggest eyewear maker, EssilorLuxottica, says Meta is planning to buy a stake. The investment would see Meta push into virtual and augmented reality for smart glasses after years of the two companies working together. Luxottica's CEO made the comments late Thursday after weeks of speculation about the U.S. tech giant's plans. He added that if Meta decides to invest, it would have to buy shares on the market, decline declining to elaborate on the size or timing of that stake. And a top candidate to succeed Boeing CEO Dave Calhoun at the end of the year has emerged. Stephanie Pope, who runs Boeing's commercial airline unit, made the rounds at Farnborough International Air Show as the plane maker's highest-ranking official in attendance. Pope was promoted to chief operating officer late last year, making her the heir apparent, and Calhoun has publicly endorsed her as his natural successor. Vice President Kamala Harris has officially joined TikTok. Since she began her presidential campaign 4 days ago, TikTok and other social media platforms have seen a groundswell of viral memes, images, and videos featuring the presumptive Democratic presidential nominee. More than 95%.
It's like one Bitcoin, apparently, in our story. One Bitcoin for a photo with the former president. Up next, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. So I think it's a slowdown story versus a recessionary consumer spending print.
That conversation up next. Live from New York City this morning. Good morning. Cape and Bank of America. Here's the latest. Consumers pulling back from post-pandemic revenge spending, and it's starting to hit the top and bottom lines of companies from food producers to airlines and luxury retailers. Sucharita Gedalia Forrester writing this. Many consumer-facing retailers, Nike, Target and others, aren't doing particularly well. I don't know that that is economy-related, but rather execution-related. Sucharita joins us now for more. Sucharita, that is a really important distinction, and we asked this at the top of the programme. There's an execution issue, then there's a consumption issue. Which one is which right now for many of these companies?
Well, in the case of some companies, like Nike's a good example, where the category may be doing okay. Their competitor, for instance, at this point in time, Adidas, seems to be having more traction. That suggests that the consumer isn't necessarily pulling back from the category altogether, or the subcategory in their case, and that issue is more related to perhaps their product assortment and some of their innovation levels. Now, from an overall consumption level, what we are seeing is that the numbers are softer than they were during the pandemic. But we have to also keep in mind that the pandemic, the economy experienced some of the highest levels of spending that we had ever seen. And that was even inflation adjusted. And then we had inflation coming on the heels of the pandemic, which ate into the real spending, but the consumer was still spending more. And now finally, I think what we are seeing is a leveling and the consumer spending not more than the inflation level. And that's where we're seeing perhaps some softness in some of these discretionary categories, as well as some essentials too, like grocery.
Essentially, you're just saying don't confuse the process of normalization with something bad, something sinister. Is that a fair assessment?
I think that that is a fair assessment. And the truth is that it's not like we have seen spending fall off a cliff. And that's important. We had record levels of consumption fueled by, of course, stimulus payments, as well as the market doing very well. So the consumer was in a really, really good place over the last few years. And it would have to be something pretty catastrophic for spending to fall off a cliff at this point.
Sucharita, can you give us a sense of history and where this suite might be that we're looking at? You pointed to Walmart, Costco, and Amazon doing well at a time where consumers are increasingly cost conscious. Yes, they are executing well. Yes, they've got economies of scale that allow them to execute well. But how much does this indicate a shift in consumer spending that gives a hint of what's to come? Maybe not falling off a cliff, but maybe a sense of where we are in the deterioration of the consumer appetite.
Well, the thing that is difficult when you look at a Walmart spend or even Costco spend is that those are businesses that do well regardless of the economy. They do particularly well when the economy is doing poorly, but they do well even when the economy is doing well because the consumer is spending more and they're going to be beneficiaries of just mass merchandise spend. So it's difficult to say right now, looking at those companies, whether that is because the consumer is feeling more nervous and cautious. Certainly, all of the consumer confidence figures are a little wacky, and this is where we have the Vive session thesis that the consumer's feeling worse than the macroeconomic indicators are suggesting. We have to also remember that wages are still relatively high. Unemployment is low. GDP growth, we just had the GDP numbers for so far yesterday, and those were really higher than what the expectations were. So the economy overall is doing well. These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Just quickly, do we still see just as wide of a divergence from upper income families and their spending versus lower income families?
That's definitely one of the theses out there. Some of the softening is that it's happening at the lower end for sure. The lower end consumer is the one that not only is going to be more likely to have to resume loan payments, and they're the ones that are going to have the higher interest rates from credit card debt that they're going to have to cope with. But and certainly the upper income consumer is the consumer that is more likely to be a beneficiary of some of the stronger stock market performance of the last year. But at the same time, that upper income consumer isn't seemingly purchasing those luxury goods. Every luxury brand, which is a public company, has reported softening in sales, although arguably that could be because of the China consumer, less so because of the U.S. consumer.
Interesting. Sucharita, thank you. Sucharita Gedalia Forrester. That's the important one, the important development for me. It's how much of the spending that's helped prop up this economy is starting to break down as well.
Yeah, that's the reason why maybe we're seeing airlines in particular not being able to win out with just some of the top tier seats.
Coming up on the programme, a somewhat self-indulgent conversation with the AC Milan CEO.
Somewhat.
Market focused, Bramwell.
It is. I've got lots of
questions.
questions.
Russell and small caps and all that good stuff. Let's start with the price section. 2 hours away from that opening bell. Equity futures pulling back by 0.75%, or rather pushing higher by 0.75%. On the Nasdaq 100 up by 1 full. Giorgio, let's talk about this move. We've seen these friendlies before. AC Milan on tour, playing other teams from the Premier League and elsewhere. It feels like we're getting closer to playing a regular season game in the United States of America. Giorgio, is that true? How close are we to an event like that taking place?
Good morning. Thanks for having me. You're right. We do these tours in the summer regularly to play friendlies against other top teams. Look, there's regulatory challenges in moving abroad and into a different market, domestic league games. But we certainly think if you really want to develop a fan base and you really want to expand your business in the US, this would be a critical part. So we will be working with Serie A, our league, and the other regulatory bodies to allow us to.
You've mentioned the bodies you need to work with. Can you just build on that? The obstacles for something like that to take place. Have you had a meeting with Serie A and the regulatory bodies about this already? Have you taken steps to kind of push this forward? How close are we to something like this?
We certainly have discussed it with Serie A. It then needs to be discussed also with UEFA and with FIFA and the authorities here in the US. There have been attempts in the not so distant past to play games. La Liga tried to, but it didn't work out. So we'll keep on pushing. It is absolutely important. Just in the same way that American leagues have expanded globally by playing regular season games, not just friendly outside of America.
Under surveillance this morning, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
So here's the latest. It's been super difficult for the airlines. American Airlines reporting disappointing earnings, slashing its profit outlook after overestimating demand for domestic travel. This as Delta returns to normal operations following last Friday's global tech outage that led to thousands of cancelled flights. Joining us to discuss this industry, Sheila Kahulu of Jefferies. Sheila, it's good to see you.
Thank you for having me.
Where do you want to start? Delta come out and say things aren't great. And then United come out and say the same things. And I'm thinking, well, we're going into American now. Surely we've lowered the bar enough and the market's looking for this. And then American come out and say things are pretty bad and the stock craters. Have we not lowered the bar enough for these airlines still?
It keeps getting worse. Air France pre-announced negatively yesterday on the Paris Olympics impact. Air Canada, Lufthansa cut EBIT by 50%. So it keeps getting worse, especially in the Atlantic yields. There's more competition, and that's what's been holding up on the international side. But American and Southwest really have both had strategic missteps. American realigned its corporate strategy, and it decided to go direct, and it really missed out on revenue points. So they're going back into that, adding Salesforce, which they've cut over the last 2 years. Southwest is Southwest. So they've had some strategic issues. And what they're doing, yesterday they said they're going to add premium seats. So instead of an aircraft with 175 seats, they're going to go to 160, which is like the Delta and United average, add extra rows of legroom, and change their onboarding strategy a bit.
It's Southwest welcome to the 2020s, like 4 years late.
Yeah.
What do you make of the timing of these executions from both American and Southwest?
I think they're realizing they're losing out on market share, and their yields are worse than everybody else, so something's got to give. It's just a matter of how quickly can they do it. I think American can do it faster. You know, as a corporate booker, I don't know how quickly, I don't know where Jefferies is booking my American Airlines flight to Heathrow at this week. So I think it's easier to regain that. Southwest is really shifting its strategy with assigned seats. And don't forget, they make about $1 billion of revenue out of their $24 billion of revenue from early board booking. So they could lose that revenue. So it's unclear how quickly Southwest could actually take share back.
So this is totally off script, but you mentioned Air France and you talked about how the bookings have actually gone down because of the Olympics. I don't get this. They're not the first to say this. We've talked to others who also say that actually travel is going down because of the Olympics. Isn't it supposed to be the opposite? Isn't
That's what I thought too.
Of cities becoming the host cities for Olympics being that it increases traffic?
Yeah, and Bastian at Delta told us otherwise. Delta has a Paris hub, so that's why it's more impacted than everybody else. But apparently, no one's going to Paris this summer, and even if they are, they're not doing multi-leg flights. So they called out about $100 million in impact. Air France called out a bigger impact. I think it's a one-time thing we could look through, but yeah, I would assume the opposite as well.
There's a question right now, not just about execution and profitability of some of these airlines, but also how do they maintain morale at a time when there are some snafus? We're talking about Delta and the issue around CrowdStrike and the fact that some of the employees didn't really feel like they knew who to call. Now, United Air is requiring a doctor's note to call out sick for pilots, and that's now being reviewed by federal officials. I'm just wondering, is that a problem at a time where execution kind of depends on these people?
No, just listen to an airline earnings call. They sound great. Peak revenue, all-time high revenues. You wouldn't know anything is wrong with an airline by listening to an airline earnings call. Things sound absolutely lovely. Revenues are at all-time highs. It's just
Where's the disconnect here?
I think that's, you have to look at profitability and what profitability looks like, what cash levels look like. American and Southwest are draining their cash balances. American won't be able to delever. Southwest keeps buying more planes. But I think, in any industry, airlines, pilots are have a great morale, so the flight attendants, and they also have contracts that they just put into place. So most of the airlines have their contracts in place. American has another cost headwind coming up. It's going to look to ratify its flight attendant contract, so that's going to be a headwind for the second half of this year and into 2025.
You really don't sound impressed with the way that Southwest is run. Is that fair to say?
I think running an airline is an extremely hard job because you book and ship right away. Prices swing 10%, and your 1 point of price is 10% of EBITDA. So you could really mess up an airline very, very quickly. So I don't envy those who have to run an airline.
You have sympathy with them, but is there something about they're running their business versus, say, Delta is that means they're performing this poorly?
I think if you focus on premium, it's a more steady base, and you have that pricing cushion. So any mistake in the domestic markets, if you put too much capacity, you're making up for it in your international side where you have 20% operating margins. So I think that's where they have a little bit of cushion with Delta and United, and they're just bigger. They have brand loyalty. They have the credit card. They have their Delta Tech Ops, so that's their maintenance business. That if they spun that off, that would probably be worth $10 to $15 billion. So they have a lot of. That just tells you what Delta is worth. If you strip away Sky Miles, you put it at a Visa multiple, and you looked at their Delta Tech Ops business, it would mean Delta Airlines as an airline is not worth anything.
Asked this question a million times. They sound like credit card companies now. Why don't they just say that they are credit companies?
They try.
Wouldn't they be better off?
I think they're really pitching that, and you saw that with United. It took out the leverage that was associated with its credit card business to essentially unencumber the asset. Granted, it was an 11% note, so it was saving them a lot of interest to put away that debt, retire that debt, but still.
From a broader perspective, just sort of zooming out, we were speaking with Sutrita earlier of Forrester Research, and she was saying that on the margins, you are seeing some pushback by even the higher end consumers. Maybe this has to do with China, LVMH, we saw Gucci, really underperforming. Are we seeing the same kind of spending patterns at the highest end of the cabin, which really had been sort of the mainstay for profitability for a lot of these companies?
I think that's what everybody's worried about with airlines, right? They're not giving them the credit for the premium offering. And we cover the biz jet manufacturers, Textron and Gulfstream. They both reported book-to-bills of 1.0, but you didn't see an acceleration in orders for the biz jets. So is that hitting the high end? You're seeing flight utilization for business jets up versus 2019 levels, 20%. But year over year, they were down 1%. So is this kind of a leveling out of even the high end, which the consumer brands would tell you is?
Sheila, you've been busy, that's for sure, over the last week. Sheila Coley there of Jefferies. Think about the changes we've seen in the last week. American, another disappointment. Southwest, a change in policy. Delta, struggling to recover from the issues that we were talking about in this show a week ago.
You asked the right question about Southwest. What took them so long? At a certain point, I understand it's the culture, and I'm sure they're getting a lot of backlash from people saying, come on, now you're going to join everybody trying to bifurcate people according to how much they're willing to spend. And Southwest would say, yeah, because we need to make money. And guess what? That's how people do it.
Still the most confusing one for me out of all the airlines in the States. You know which one I'm going to name? JetBlue. I don't understand JetBlue. They've got a serious branding problem. If you go on a JetBlue flight, the customer service is absolutely phenomenal. You and I both shared a flight, transatlantic to London. Fantastic flight. Flew business with work. Thank you. With work. And it was fantastic. It was brilliant. It was up there with the likes of Delta, with the likes of American. And I just don't feel like that they market that well enough in any way, shape or form.
Because they want to cater to families. Look at their routes going down to Florida, going down to the islands. That's the sort of, you go and people put on hats and they're with their families. They're excited. It sounds really nice.
But they sound budget when they're not. Do you know what I mean? They're sort of like,
It's like big box stores trying to look cheap.
Yeah, I don't. Anyway, coming up, less on JetBlue. Less on AC Milan even. Up next on the programme, Sam Stilwell of CFRA.
Throughout this earnings season, there is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have
the euro just a little bit stronger, 108.62. Coming up this hour, we'll catch up with Sam Stovall of CFRA as the equity bull market hits a bit of a wall.
Well, I think what that implies is that investors are really only looking short term because the investment that Alphabet was making is obviously for 2025, 2026, which is the cause for our optimism longer term. But in the near term, investors are basically saying that recently we had tech selling at a 78% premium to its average 20-year PE ratio, the market itself at a 38% premium, and the relative strength between the cap-weighted tech and equal-weighted tech sectors were back to where we were during the dot-com bubble. So I think that investors are saying if there's any hint of disappointment, I'd rather sell first and ask questions later.
Sam, I guess another way of putting this together is how low is the bar right now heading into next week for some of these earnings? After the sell-off, we've seen a true correction down about 13% since the July 10th record highs that we saw in the Magnificent Seven stocks. How much do you anticipate that any additional disappointment or even just not superlative type of results will provoke some pretty significant selling in addition to what we've already seen?
Well, I'm looking at history. I would tend to say that we are due for a double-digit decline in the order of 10 to 13%, primarily because of the advance that we experienced in the first quarter, as well as for the first half, and as I had mentioned in terms of the valuations. However, I do think it'll be contained to a correction, not the beginning of a new bear market, and would probably end up representing a good buying opportunity as we approach the fourth quarter of this election year. Let me also mention that when it comes to elections, there's the possibility of a red wave, and whenever we have had waves in the past, we've had 3 Republican waves since World War II, 7 Democratic waves since World War II, that has added a percentage and a half to the average return in the first year of a new administration.
So let me get this right, Sam. A lot of people are saying that a red wave or a blue wave, but in this case a red wave, would actually cause inflation to go up and could become a problem for the bond market. You see it as the opposite, that actually any kind of dominance in Congress would actually lead to greater returns in equity markets. Is that correct?
That's what has historically happened, but obviously it's going to depend on what the new administration puts forth. If we do see, in a sense, very high walls in terms of tariffs and whatnot across the globe, then yes, that will end up being very restrictive, would be a hurt to our exports, would certainly smell of, or have the sniff test of the Smoot-Hawley tariff back in the early 1930s, which restricted global trade. So I don't think that would be a very good thing, and I believe that those who end up being in power would be very much aware of that.
Sam, just taking a step back, it seems like you're still pretty constructive on the overall backdrop for the U.S. economy. It doesn't seem like you're sort of expecting a major fall off the cliff type of moment. What would you have to see to change that view for some of the growth worries to become a true growth scare for you?
Well, as I had mentioned, the valuations were stretched, in my opinion, 78% premium for tech. Now it's down to about 64%. So some more slight downward rotation for tech, I think, would be encouraging. I think if we get a softer than expected PCE reading this morning, that could also help talk the market off the ledge. And because we've been seeing an improvement in the rotation beneath the surface, our Lowry technical analysis arm has been showing an encouraging amount of supply-demand indicators that they monitor to say that while a short-term pullback could certainly be in order, that they are looking at that as a good buying opportunity.
Let's see what we get in 20 minutes. Hey, Sam, thank you, sir. Sam Stovall there of CFRA. This from Ian Lincoln of BMO. He says, happy anniversary. I opened up the email thinking, what on earth is he talking about? And then he said it was exactly 1 year ago, July 26, 2023, that the FOMC brought Fed funds to this cycle's terminal rate of 5.25 to 5.50. Also the anniversary of the Draghi whatever it takes Bumblebee speech back in 2012. We're going back a long time, aren't we? 12 years.
So at this point, I'm wondering how long beyond this are we going to see a difference in the Fed funds rate? I guess a lot of people are expecting it is not going to be next week, but can you imagine if it were a full 1 year kind of pathway?
They cut
really,
rates?
yeah, and it would be this sort of very...
It's perfect.
Yeah, it would have this sort of, arc to it, narrative arc.
Think about this. I was just reflecting on the Draghi speech, the Bumblebee speech back in 2012. I know people who were in the room, and the people in the room at the time didn't feel like it was a big deal. That's what was amazing about that speech. People at the time didn't feel like it was a big deal. And then it was like the days afterwards that we started to put together, hang on a minute, is he going to come together with some big plan here that's going to turn around the whole story? Lifetime ago. Can't believe that time has gone by as quickly as it has. 12 years. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John.
More. Senator, it's wonderful to catch up with you, sir. I understand you are attending the cryptocurrency industry conference in Nashville, and we'll touch on that in just a moment. I just want to gauge where you sit on certain issues in foreign exchange, Senator, given our conversation with the former president of Bloomberg Business Week in the last week. The former president, Donald Trump, said this about the currency. He says the United States has a currency problem. I understand we have a technical issue with the senator. Can the senator hear me still, even if we can't see him and the shot is frozen? Can you confirm that? We can't hear him either. OK, so we've got a bit of a technical issue. We'll try and confirm a re-established connection in just a moment. The conversation I wanted to have was around foreign exchange, Lisa, and the first question would have been, and I'll share that with you right now, ultimately, if we've got a currency problem, what can they do about it in Treasury?
Yeah, especially at a time when ultimately this is about the Bank of Japan holding rates incredibly low and the U.S. having a strong economy. Potentially, how do you further the idea of a weaker dollar if you do pursue some of the policies that Donald Trump has talked about, including higher tariffs, including reducing certain immigration?
Deutsche Bank have this to say.
Good and actually shows that a healing economy is going to let some of the other companies other than big tech really benefit? Or does this begin a sort of downward spiral that at least can cause a deeper correction? The answer has been unclear.
Mike McKee dropping by the studio ahead of this breaking economic data. Mike, we've had some data already this week. GDP was better, jobless claims a little bit lower. What are you looking for from the numbers later this morning?
Better. It's a good way to put it. We're expecting a slight decline from the PCE inflation numbers, although this is going to be a three-digit issue here today because there are some questions about whether they might come in stronger than anticipated because of rounding effects. You know, so it's a 0.1% change for the PCE price index, but if it's 1.6, then it's going to round up to 2, and that might worry some people. But in general, we're expecting overall inflation to be down and spending to be reasonably good because we saw that in the GDP report yesterday.
In 30 seconds, was yesterday's GDP print as good as it was, as people thought that it was on its face?
It's better than I think some people are looking at because a lot of it was based on consumption, and that's what the Fed wants to see. People were not necessarily pulling back. They're spending a little less, but it looks reasonably good. So overall, not too bad. And the good news today is this is an 8:30 number, and everybody can head out to the beach or whatever relatively early today.
That's the good news, unless you're hanging out for you, Mitch.
Well,
you hanging out for you, Mitch?
Yeah, I am hanging out.
Okay, good for you.
But after that, we'll go. Then we can go home and,
Some of us are not hanging out for you.
And we're got to be at a point sometime soon, given that Jay Powell and others at the Fed have said we're going to have to start lowering rates before we get to the 2% target. I mean, we're in range now. He has said 2.5.
You've made the point also, Mike, that you think to some extent this market's already doing the work for them. That all they need to do next week is just sort of validate what the market's priced for. Is that fair?
I think that's the case. If they suggest strongly in the statement or Jay Powell's news conference that we're going to see a September rate cut, then their market's going to price that in, and they're going to get the effect of a rate cut in July.
Going into the next week, we have a lot coming up. We've got, of course, the FOMC meeting. We also have the Treasury refunding announcement. And we've got some of the tech earnings capped off with the jobs report on Friday. From the Fed's perspective, how much are they watching some of those pivotal earnings, given that the signals from corporate executives have been some of the most forward-looking indicators that a lot of economists have hooked into?
Well, they'll pay a lot of attention to it, and they're always talking to the CEOs in their districts all the time, and the Board of Governors is out talking to people. So they have a pretty good idea of what these executives are thinking. And obviously, with the Fed, it's going to be the same as it is with investors. You're going to be looking at what the forward-looking forecast is for earnings at these companies. And then if anybody says anything about layoffs or anything like that, right now earnings seem to be coming in okay given the situation, and the forecasts for 2025 are pretty good. So the Fed is not overly worried about recession at this point. But I will say one thing, and that is I don't want to dismiss the idea of this slowing economy too much because we don't get the jobs report until next Friday. And if that shows 4.2%, then you trigger the Somm rule, and it scares investors and it scares the horses, and then it maybe scares the Fed. So we have to wait and see how that turns out.
The Citi thinks we hit 4.2 next week. I'm far more interested in how the market responds to this than the Federal Reserve, because the Federal Reserve knows we're close to it and they don't seem too worried about it. Bill Dudley, the former New York Fed president, suggests that they should be. I just wonder if the market sees that, given how well-known that rule has become, particularly over the last few years, Lisa, that people begin to price in what they believe will be, with certainty in their minds, a recession.
What I find interesting is that for most of this year, the volatility was in the bond market. We saw pretty massive fluctuations. Over the past couple of weeks, yes, we've seen some real moves in the bond market, but the volatility has been in the stock market. How much will the stock market, will risk assets actually respond to a downside surprise or in that jobs report or a 4.2% unemployment report, much more than even the bond market, which is already pricing in a good deal of rate cutting?
Next to no news yesterday on Nvidia. The range down by 6.9% of the lows, the highs positive 2%. That's a massive range on one of the biggest companies on the planet. Talk about volatility.
And we've seen it index-wide, and that, I think, is sort of different. We've seen it in specific stocks, but not index-wide in the same kind of way as we have over the past couple of weeks.
Let's get to the price action, and then we'll build on this conversation on the economic side of things. Equity futures going into the opening bell in about an hour from now, positive by 0.8, on the Nasdaq up by 1%, on the Russell up by 1.4. In the bond market, we look a little something like this. Yields lower by 2 basis points on a 2-year, 440, down about 2 as well on a 10-year at 421.72. Nothing too scary in this economic data this morning. To discuss, I'm pleased to say, a good friend of this program over the years, Mark Zandy of Moody's Analytics, joins us now for more. Mark, you think maybe we've been too high for too long at this Federal Reserve. How would you like to see this conversation change next Wednesday?
Well, I mean, at this point, Jonathan, I think September is when the Fed wants to cut and when they will cut. So I just think they're going to reaffirm that with this meeting and press conference and everything else that goes around it. So I think it's all about just confirming current market expectations. And investors, you probably know better than I, but I think there's a close to 100% probability to expect a September rate cut. Today's data is consistent with that, and I think that's the language we're going to hear next week from the Fed, that they're just going to cement that expectation.
Mark, the Fed believes they've got time, and we had this exchange with Bill Dudley. I'm sure you read his piece on Bloomberg Opinion earlier this week. The former New York Fed president suggesting that maybe they're miscalculating how much time they have, taking too much comfort away from what's developing in the labour market. As you look across the labour market, I just want to understand what's on your dashboard right now, Mark. What is concerning you? What stands out? What's sort of flashing brightly for you?
Well, I agree with Bill. I think the Fed should, I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The objective is full employment, check, 4.1% unemployment rate, and low and stable inflation. And I say check. I mean, the PCE inflation is 2.5% within spitting distance of their target. Everything is headed in the right direction. And, we've been reduced to going to the second and third significant digit here. But if you do that with today's numbers, you're right on target. And the other thing I'd say is, if you exclude the cost of the implicit cost of home ownership, which I think you should do, there's growing evidence that is not really helpful in setting monetary policy. The PCE deflator is at 2% or below, and has on a year-over-year basis has been there for more than a year. So you got to ask yourself the question: well, why a 5.5% funds rate target when you've achieved your objectives? And I'd say, if you're saying the counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? I mean, it's in the job market, what's going on in the financial system. It just strongly argues to me that the Fed should be cutting rates. But having said all of that, it looks like September. I'll take it.
Mark, one thing that we were talking to with Bill Dudley was, why now? What triggered this shift in view that it is time to cut rates in possibly even next week, given that the economy is still hanging in there? And you're saying, well, why wait? Because you see enough signs of weakening. You point to something else, and that's the downward revisions in the labor market for prior months. That concerns you. Why is that important?
Well, Lisa, it's the plethora of labor market data suggests that it's downshifting in a pretty meaningful way. The downward revisions to previous payroll employment reports is consistent with that. But there's a lot of other evidence. I mean, hours worked are down, hiring rates are down, quit rates are down, temp jobs are down. The only thing that's kind of hanging in there really well is layoffs. They feel like they're picking up a little bit, but they're low, and that's great. But we don't have a really good theory as to why businesses are so reluctant to lay off. We've got theories, labor hoarding kind of theories, but they feel rather tenuous to me. And as we saw in the tech sector a little over a year ago, high-flying companies that are hiring boats loaded of people can turn around pretty quickly and start laying off workers pretty quickly. So, I think things can change very fast. And once they change, it's too late. It's too late. The other thing, at least I'd say, is it's not only about the labor market. It's about the financial system. The financial system is under a lot of pressure. The yield curve, the difference between short and long rates is still inverted, and that's a very uncomfortable place for banks and other non-bank financial institutions. You throw in weakening credit quality, slower loan growth because of the tightening and underwriting in the wake of last year's banking crisis, higher regulatory costs. The operating environment is pretty tough, and so something could break in the financial system. And as we saw from the crisis a little over a year ago, that can happen also very quickly. So why take that chance?
You're talking about things changing very fast and the potential financial pressures. We're seeing a lot of volatility in certain stocks. Some people would say it's technical. We're also seeing it in certain currency pairs. And there's been a lot of speculation about what kind of technical backdrop there is for this. Do you think that is cause to really build on your worry about a financial system that's stretched, that's seeing a sort of outsized moves in response to not that significant catalyst, simply because there aren't sort of the buffers that there have been in the past?
Yeah, it's a good point. I mean, my focus is more on the bond market, and you can kind of feel it there. The liquidity in the market just doesn't feel good. I mean, I've been watching the bond market for decades. You go back not too long ago, if you saw the 10-year treasury yield move a couple, 3 basis points, you go, that's a big move. Now it's moving 10, 20 basis points in a day, in an hour. So I do think liquidity is an issue, and there's some structural problems there, right? I mean, the big broker dealers that make those markets haven't been able to or willing to expand their balance sheets to remain consistent with the growth in the amount of debt outstanding. We've got all this treasury debt coming into the market because of large budget deficits, but because of capital rules and liquidity rules, banks have not expanded those balance sheets, and therefore the market just feels really fragile to me in terms of liquidity. And yeah, we could get a liquidity event, and it's happened in the past, and certainly is a risk going forward.
Mark, just before you go, I've seen a lot of growth scares in financial markets over the years. I'm sure you have too. I can't think of a time when I've heard so much about the SARM rule as I have this time around. It's like everyone's talking about it in financial markets. Now, I know in your world, in the world of economics, we've been talking about this for a while, but financial market participant, investor after investor, all talking about the same thing. Mark, if we trigger that next Friday, do you think market participants, based on conversations you've been having, will begin to behave like it's here, the recession's arrived?
No, I don't think investors are slave to any one indicator, and every indicator's got its issues. I mean, the SOMS rules, it's something certainly to watch, but obviously unemployment is ticking higher because of labor supply, right? We've got a lot of foreign immigrants coming into the country, starting to work, and that's causing the unemployment to rise. So it depends why the unemployment rate is rising. Is it labor supply, as it is today, or is it labor demand? And I think it's more supply than demand. So you have to take all these things into consideration, and I think investors are pretty smart. They do that as well. But it's just one other indicator, along with all the other indicators I just articulated, to suggest, look, the labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You achieved your goals. Let's get going.
Mark Zandi. Mark, appreciate it. Let's catch up soon. Mark Zandi there of Moody's Analytics on the Federal Reserve. Next week's an interesting one. We often sit here and we say it's the most important jobs report since the last one until the next one. I do think this jobs report next Friday takes on some additional importance, don't you?
It is definitely the most important report since the last one until the next one, 100%. And I will tell you it does, because we don't have a clear sense of exactly where we are on the trajectory.
It's not like that July 4th payrolls report when everyone went to the beach and Mike McKee was stuck here breaking it down. This one feels more important.
We had fun without you.
I'm sure you did. How important do you think this is next Friday?
I think Lisa summed it up well. Most important since the last one, because because we're going to have another one before the September meeting.
Right.
So it will continue to, although because we're so close to the Somme rule, as you pointed out, it will garner interest. Unemployment has to be the first number I mention on a week.
I agree. I think for a lot of people, that's like the indicator next Friday. Mike, appreciate it. Thanks for today. And this week, appreciate it. Thank you. Let's get you up to speed on some stories elsewhere with your Bloomberg brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The SEC is suing short seller Andrew Left and his Citron Capital, accusing him of committing fraud through stock trades, social media posts, and research reports. The SEC is alleging that Left and Citron generated about $20 million in illegal profits. The regulator claims that Left would make a recommendation alongside a price target and then capitalize on the resulting movements, but on prices far different than what he recommended. Left had no immediate comment. Canada
came on here and said, actually, she has a good sense of all of it. She wants to see the Treasury refunding announcement to see exactly what maturities of treasuries the U.S. government is going to sell. So a lot going on.
A lot of people in Camp Bramo, aren't they? Treasury refunding next week?
Do you know how many people have messaged me to be like, stay on the auctions? The auctions are important. Don't let John bully you about auctions.
John Bully, let me tell you how commercial breaks go.
Not
that way around. Not that way around.
Big boy.
AMH and Bramo teaming up.
Oh, yeah.
Giving me grief.
So terrible.
Let's get to the weekend. It looks like this. The Mag 7 results coming in thick and fast. We hear from the likes of Microsoft, Meta, Apple, and Amazon. You've got to wait until the end of August for NVIDIA, and we've said it already this week that they need to change that. Mandeep Singh of Bloomberg Intelligence. Mandeep, do you agree? We need to bring that in. Why do we need to wait until the end of August for NVIDIA?
Save the best for the last. So, that's been the theme for the last few quarters. But clearly, I think Microsoft is very important in terms of keeping this AI trade going because everyone realizes Microsoft is at the forefront of both ramping up the CapEx side as well as the cloud deployment. I mean, look, this is a company that has actually got a live product, Copilot, that is generating revenue. And you want to see that AI lift in the numbers when they report next week. So I think that's the one to watch.
You framed it perfectly earlier this week, and we extended that conversation through this morning with a couple of guests as well. If you look at the reaction to earnings so far, you can start to gauge what investors are rewarding companies for and what they're punishing companies for. And the example you used was Alphabet. Can we start there? What did investors punish Alphabet for? And how do you see that setting us up for next week when we hear from the likes of Meta and the other big players?
Yeah, I mean, in the case of Alphabet, they didn't have a timeline for when these CapEx increases would go away. I mean, they're clearly spending 60 to 70% above their historical CapEx, and typically this reverts to the mean. They're not saying that because they think it's a long runway. I think Meta is going to do the same. And look, as an investor, you don't mind, companies spending, especially the companies that generate $100 billion in free cash flow like Alphabet does. So it's a good way to spend on new technology, but you do want to see the monetization. And in the case of Alphabet, the search revenue did accelerate sequentially, but it was 1 percentage point of acceleration. So clearly, they're not losing any share. They have kind of reclaimed their mojo in terms of being ahead on the search side. But you do want to see a more meaningful lift, which is what everyone is hoping Microsoft can show in the results.
So we get Microsoft, we get Meta, we get Apple, we get Amazon all next week. Of those, which do you think is going to be potentially either the biggest surprise or that you are most curious about?
I mean, Amazon. Look, in the case of Amazon, especially the AWS side, everyone thinks they are behind the curve when it comes to generative AI because remember, Amazon is the largest cloud player. AWS generates $100 billion in revenue run rate. Azure is 76, and Google Cloud is 40 billion. But their growth rate seems to be decelerating. So this quarter, it's high teens. Everyone else is growing around 30%, Azure, Google Cloud. So you want to see them actually surprise with the upside just to assure investors that they're not lagging behind on the cloud side. And I think that's still uncertain.
I'm super interested in Apple. What does Apple look like in China? We've had that guide again to suggest that the iPhone's struggling a little bit in the mainland, and then Apple came out last time around and said nothing to see here. There isn't a big problem. I just wonder if we hear the same commentary next week.
Yeah, and whether they talk about production and how much they're diversifying that, and whether they talk about the Treasury refunding announcement.
Of course they will. Yeah, that will come up too. Luca Maestri, by the way, is an amazing timer of the bond market, isn't he?
By the way, I just want to point out something. All of these big tech companies have benefited so much from rates where they are because they've got so much cash and they're keeping them in T-bills. And they've been absolutely cashing in. So it raises this question of what is interest rate sensitivity for some
How did we get back to the deficit, Treasury issuance and that with tech firms? But we did. Okay, anytime. Mandeep, thank you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence. Lisa, thank you. Appreciate it.
For what?
Anne-Marie, thank you. It's off next week, by the way. Anytime. We'll see you next week on Monday. Terry Haynes of Pangea Policy, Lindsay Piegza of Stifel, Amanda Lynham of BlackRock, Kevin Gordon of Charles Schwab.